I'm Dr. Vibha Jain from Janki Devi Memorial College, Delhi University from Commerce Department. I'll be taking today the capital budgeting decisions. Okay. Now, first of all, the question arises, what do you mean by the capital budgeting decisions? Capital budgeting decision is nothing but a investment decision. The long-term investment decisions are called as the capital budgeting decision. The reason for the name or the nomenclature is because it involves a lot of capital and it is for a long-term purposes. And therefore, this is being generally called as the capital budgeting decisions. That means it is allocated to the investable fund to the different long-term assets. And they denote a situation where the lump sum funds are in the investment in the initial stages of the project and the returns are expected over a period of time. It is not for 1 year, 2 year. Whatever the decision we will be taking, the effect of that decision will be for a longer period of time, and therefore we have to be very careful. Okay. The next, what I can tell you is that it involves the entire process of the decision making relating to the long-term capital. Fine. That is the acquisition of the long-term assets whose return are expected to arise over a period beyond 1 year. Therefore, it's called as a long-term decisions, okay, which involves the outflow of the cash in the initial period and afterward it involves the inflow of the cash. It involves the huge amount of the capital, and again that is another reason why we should be very careful. And generally it is irreversible in nature, because once you have set up the project, once you have purchased the long-term machinery, the capital machinery, it is very difficult to reverse the decision, and therefore whatever the cost you are incurring here, that will be nothing but a sunk cost. Now, when it is a sunk cost, just try to understand that it determines the asset side of a firm's balance sheet and it determines the earning capacity of the firm. These decisions are highly risky. Why it is risky? Because it is irreversible and it is for a longer period of time, and hence it is of a very strategic importance. These decisions are taken at a comparatively higher levels in the management. The lower level of the management don't take these decisions. These have to be taken at a higher level of management. Okay. Now, what type of investment decisions are made by the company? These can be the project selection, these can be related to the modernization, these can be related to the replacement, these can be for the renovation, these can be for the introduction of a new product line or any other thing. Fine. And therefore, remember, these are irreversible in nature and for a longer period of time. One, proper estimation of the cash outlays will be there. Then second, the proper estimation of subsequent cash outflows will be there. The third, proper choice of the selection of the criteria will be there. And therefore, these are the three main points which I'll be discussing with you. First of all, understand, here I have given you the word cash outlays. Here I am again giving you the word cash outflows or the cash inflow. The main point comes out is that why we are taking into account the cash inflows and outflows and not the profitability of any machinery, any business. Why we are not concentrating on profitability? Understand it properly that in that particular case, in the case of the profitability, you must have done the financial accounting beforehand. And in finding out the profitability, we have got so many assumptions with us. Like, for the sake of an example, I am giving you the example of a depreciation. When you are taking the depreciation into account while calculating the profit, depreciation is, what is depreciation? It does not involve the cash outflow. It involves only the expenditure. We are treating the depreciation as an expenditure. We do write down on the debit side of the P&L account. But tell me, For the depreciation, there are 15 methods for the depreciation, and every method is giving you the different result. When every method is giving you the different result, that means if one company takes up one type of method, second company adopts a second method, the profitability which they are calculating would be different. And therefore, the profitability on which you are deciding upon whether this machinery should be installed or not, it will not be correct. It will not be comparable. Therefore, what we do, another important point, let me discuss the second point before coming to the conclusion. The main point is that you are incurring the expenditure throughout the period. Now, whatever the expenditure you have incurred in the beginning of the period, in the after 1 month, after 2 months, after 1 year, that means you tell me whether the purchasing power would be the same. You tell me, if I have purchased the raw material in the very first month on the 1st January, worth rupees 10 lakhs, okay, now I am purchasing the raw material, the same quality, same thing, purchase the same quantity in the month of June, but the prices have increased. When the prices have increased, is it that the same quantity of the raw material I'll be able to purchase in the same 10 lakh rupees? No, I have to say, suppose give 11 lakhs for the same quantity. Now, what in the financial accounting we are doing? We are not considering the time value of the money. That means the 1 rupee in the month of January, we are equating with the 1 rupee in the month of June. Okay, which is a major flaw, and therefore we are not taking into account the financial accounting profit for the taking up this capital budgeting decisions. We are taking the basic of the financial decision making or the capital budgeting decision making is the cash flows. How much the cash is going out and how much the cash is coming in. Let's discuss one by one these points. Okay, just see, the heading is why cash flows and not the profit. Just read it. The accounting profit ignores the concept of the time value of money. I've just given you the example. Whereas the cash flow concept takes into account the time value of money, which is a major base for taking any financial decision. Now, in the capital budgeting, a finance manager is concerned with measuring the economic value created by a decision rather than a book value, which is a major difference. Here we have to find out that whether the economic value is increasing over a period of time or not. Fine, which we can find out only by application of the cash flow concept and not by the application of the profit concept. Okay, and therefore let's take up the third point. In cash flow analysis, the cost and benefits are measured in the terms of actual cash coming and going. While in the case of the profit calculation, we are taking the accrued income and expenditure also. Accrued means that it has occurred, but we have not paid or we have not received, and therefore that we are not taking into account. Okay. Another thing, if you look upon, the accounting profits are influenced and affected by adopting one or the other accounting policy. The accounting policy differ for the various companies. I have just given you the example of the depreciation. You can take any other example of the inventory or any other thing. We have got the flexibility to adopt any accounting policy. And if we are adopting different accounting policies, then in that case, what will happen? The profit figure which we are getting will be different, and those profit figure will not be comparable. And therefore, another reason why we are not taking the accounting profit as the base. Fine. Therefore, now we have to find out that, okay, we have to take the cash flows, but relevant cash flows. Okay. Now, what do you mean by the relevant cost flows? Relevant means the cost which we are incurring for the purpose of that decision making. It can be, for the sake of an example, the cost of a fixed assets. That is the relevant cash flow for the purpose of decision making. That is, example, a purchases price. It includes the purchase price is an obvious thing, you will understand that. But if we are incurring any other cost in order to make that thing ready for the purpose of production, then all those costs will also be merged, just like the import duties or any other refundable taxes. Okay, the cost of bringing the assets to the working condition that I have already discussed. Suppose some installation charges have to be incurred. Those installation charges has to be added in the cost of the asset. The cost of site preparation, I have to make that asset under the working condition. Whatever are the costs which we have to incur, in order to make that asset under the working condition, all the costs will be added up. Here, the initial delivery and the handling charges, because this is again a must cost, which we have to add up in the cost of purchase. Okay, and therefore, if we take up the installation cost, if we take up the interest cost during the construction period only, then in that case, the professional fees which I have to pay to the person concerned who will tell me how to operate the machinery, that professional fees has to be added up. That means such a cost be reduced by the inflows from the sale of the old asset. This is a very important point. Suppose I had already got the machinery. Now in that machinery that is not under a good working condition, and therefore I want to replace that machinery with a new machinery. What happens is, when I'll just shortlisting the new machinery, I've shortlisted suppose 2 new machinery that I can either install A machinery or I can install B machinery. After the thorough analysis, I have shortlisted and I have finalized numbered second. Now when I am taking the second machinery, the already installed machinery, I'll sell it off. Okay, whatever the price I'll be getting with the old machinery, just by the sale of the old machinery or by the exchange of the old machinery, that I have to reduce from the total price which I have to pay. Let me give you the example. Now you have to replace your refrigerator. Okay, now what happens? You have shortlisted one refrigerator. Suppose that refrigerator is 1,20,000. Now what the shopkeeper says to you that, okay ma'am, if you give us the old one, we will do the exchange. Okay, and in the exchange scheme, I'll reduce 15,000 for the old one. You tell me what is the cost of the new one now I've got only 1,05,000. Now in that 1,05,000, I'll take that 1,05,000 instead of 1,20,000 here. That is such a cost we reduce by the inflows from the sale of the old asset. That is what I have to do it. Now therefore, what the relevant cash flows are. All cost and revenue generated before and prior to the investment appraisal decision should be ignored, because that is not for the decision of this particular replacement. Okay, it basically means ignore the sunk cost. A very important point, do remember. Ignore all non-incremental cash flows, that is, exclude all those cash flows that will be there whether there is project is not there or not. A very important point. When you are replacing suppose a new machinery, or you are just introducing a new machinery because you are introducing new product. Now in that case, you had already building with you, that big vacant building was there. Now the building cost will not be included, or if some labor was there which was already there and now you have not to appoint the new labor, or the electricity or any other thing which is not been changing because of this decision will not be included in this evaluation. That is the main thing which you have to understand. That means if any cost you are not incurring because of this investment decision, you will not include that cost. All allocated costs should be ignored. That is, suppose the building cost is there. Now you will not take the proportionate building cost for this machinery. Why? Because the building cost has not been increased because of this decision. It was already there, it was vacant, and hence you have not to include that. Fine. That any increase in net working capital due to a project should be taken as a part of the project cost. What is that? Whenever you are increasing the working capital or decreasing the working capital, I already told you that any change in the cost because of this decision has to be taken into account. Now, what is working capital? It's nothing but the day-to-day capital needed for the day-to-day meeting the expenditure. Whatever the expenditure you are incurring or the liabilities are there, for that particular purpose, whatever the capital you need, that is called as a working capital or a circulating capital. Okay, now, if there is any change in that working capital, that you have to take into account as a part of a cash outlay in the initial period only if it is in the initial period. Suppose in the initial period there is an increase of working capital of 10,000 rupee, that you will add up here in the cash outflow. But after 3 years, because the expected increase in the sales is there, therefore you need more 20,000 working capital. That you will take as an outflow in the third period only. That is a very important point which you have to take into account. Another rule, cost of to the project of the resources that a firm is already having in its stock. 3 possible options are there. One could be a historic cost, another could be the current replacement cost, another could be resale value or the disposal value. Fine. These 3 costs we have to really take into account, and if they have given you in your case study or in the question that what was the book value and at what price it has been sold off, then in that case try to calculate the profit or loss on that sale, and then you have to take into account the tax also. If you are earning the capital profit, then you have to pay the tax. But if you are having the capital loss, then the saving of the tax will be there. Those things have to be taken into account while calculating the cash flows. Okay, that is the point. The next is the cost of those resources that are limited and scarce but are in use in the firm for some other purposes should be taken as their opportunity cost. Very important point which generally you people do the mistake. That is, if some space is there which I was temporarily using for any other product, but now the new product has been launched, as a result now I'll use this space for this particular product. Now whatever the cost has been foregone, whatever the revenue has been foregone because of that will become the cost of this product, and hence has to be taken as a opportunity cost. Read it again. The cost of those resources that are limited or scarce but are in use in the firm for some other purposes should be taken as their opportunity cost. You can take the raw material example. You can take the byproduct example. If some byproduct was being used, was being generated and being used for some other purpose, but now you will not be able to use. So whatever you were using that byproduct, whatever is the value of that, that has to be taken as the opportunity cost over here. Fine. Rule number 7. Then remember that all the cash flows are to be determined from the firm's point of view and not from the equity point of view. Very important, because that will be the cost to the firm and not for any other purpose. Fine. Now, just see that how you have to take the estimation of the cash flow subsequent to the installment or the installation of a machinery. Those things I have discussed in the 0 period. That is, in the 0 period, whenever you are taking the decision, whatever are the costs, those costs you have to take into account in the determination of the cash outflows and inflows. But now I am taking it for the subsequent period. Might be the machinery which you are installing has got the 10-year life. So 0 period cost or the inflows you have already discussed. We have already discussed. Fine. But now I want to take it for the other periods. That is, it requires the determination of the net cash flows due to the operation and use of the asset. What will happen? Once you have installed the asset, now you will be needing the raw material, you will be needing labor, you will be needing so many other costs. And the sales will also be there. Whatever the product you will be manufacturing, you will be selling it on. Now I have to find out for the further period the cash inflows which are expected from that installation of the new machinery or the replacement of the machinery. Now what you have to find out? You have to take up all the cash inflows, you have to take up all the cash outflows, and then subtract the two. Whatever the net effect will come, you will be taking out that thing. This is the first point, that it requires the determination of the net cash flows due to the operation. But you have to take up only the operational cost and not the other non-operational cost has not to be taken into account. That is, if you are investing somewhere or any other thing you are doing, that has not to be taken into account. This is a very important point. Ignore all financing cash flows. Now, what is called as a financing cash flow? Financing cash flows are not the operational cash flow. Those are if you have made some investment and you are getting the dividend, if you have borrowed the money and you are paying the interest, all those type of things will have not to be taken into account. Their tax effect as the capital budgeting decisions are the real decision and hence their analysis should not be affected. Please remember, it's not, should not be affected by the financing decision. Again, what is the reason behind this rule? Might be possible there are two people who are replacing the same type of a machine, same cost. One person has got their own money. Fine, they have got their own capital and therefore he is financing that replacement of the machine from his own capital. But the other person doesn't have the capital. As a result, he has borrowed the money from the bank. Okay, suppose at 9% rate of interest. Now the second person has to pay 9%, but the first person has not to pay that 9%. If you take that 9% cost, then in that case, the cost of producing or producing the final product in the second case will be shoot up. As a result, these two are not comparable. In order to make them comparable, we are not taking the financing cash flows. Okay, the cash flow should be determined as if they are occurring to the firm and not to the shareholder. It's a very important point because the machinery is being replaced in the firm and it's indirectly it is going to the effects will go to the shareholder, but directly it is the firm's property and therefore we have not to take into account that. Fine. Now, just see, ignore all allocated expenditure. This I had already told you. Depreciation and all other non-cash charges should be ignored. I had already told you. It's for the sake of an example, I have given you the depreciation word. That is the cash flow. Because in depreciation, it's only an entry. No cash flow is being affected. That amount is not going out of the firm. Therefore, that has to be ignored. And this is true with respect to any accrued expenditure or accrued income. Accrued means the expenditure has been incurred, but the payment has not been done, just like the salary. The salary becomes due on 31st of every month. But is it that always it is being paid on 31st? Suppose it is being paid on 5th of the next month. That means for those 4 days, it is accrued but not being paid. That means no cash outflow is there. And therefore, they say that no accrued expenditure or any expenditure, any income where there is no actual cash flow will not have to be taken into account here. Fine. Another point they say is that don't forget to take into account the effect of an investment decision on the remaining position. That means if suppose I have introduced a new product line and because of that new product, my sale of the previous product will come down by 20%. Just for the sake of an example. Now, whatever the loss of profit because of the reduction of the sale of that 20% will be there, that will become the cost of this new decision making. This has to be taken into account that becomes the opportunity cost of taking up this decision and therefore we have to take into account that thing which is very important and generally we forget to take that. Another point, take the net cash flows after the tax without recognizing the benefits of tax on the interest amount as the discount rate used for the discounting future cash flow is determined after the tax. Very, very important point. That is, we have to take into account the cash flows after the taxation. And that is the reason why I told you in finding out the cash outflows also, if there is any loss on the sale or gain on the sale, we have to take into account the taxation there also. Remember, because whenever we will discount it, you have already done the time value of money, you have already done the present value of money. Whenever, because these cash flows I'll be getting in the different periods of time. Suppose it's a 10-year period. So 10-year may, first year you will be getting cash inflows, second year you will be getting cash flows, and so on up till 10th year. Now you tell me whether the cash inflow obtained in the first year is comparable to the cash inflow which I am obtaining in the 10th year. No, I have to make them equal by discounting the 10th year cash flow for the 0 period, second year, 9th year cash flow for the 0 period, and so on. All the cash flows I have to discount. When I have to discount, I have to find out one rate of interest, and that rate of interest will be determined after the taxation only. And that's why in order to equate both the thing, cash flows also we have to calculate after the taxation. Interest also, the cost of capital will also have to be calculated after the tax, so that both are on the same footing and we can do the exercise. Now remember to incorporate the opportunity cost of the resources used to generate the cash flow and ignore the sunk cost. That's very true. I have discussed in the second slide also that sunk cost has to be avoided. The cost which has not been affected by the decision making is not to be taken into account. Okay, that's a very important thing, and therefore now the classification of the cash flows are there. There would be main three things. One would be the original cash flows. The second would be, in the original cash flows, we have to take into account the installation cost. We have to take into account the sunk cost. We have to take into account the opportunity cost, the additional working capital requirement, and the subsequent inflows and outflows, and in the last, the terminal cash inflow. Don't get confused that here I have written the sunk cost. Here I have written the sunk cost in a different sense. Okay, that is whatever the cost has been incurred for the benefit of this particular decision. But it is irreversible. It cannot be taken it back. In that sense, I had written here. Therefore, mainly three things you have to find out. The original cash outflows, then the subsequent cash inflows and outflows. If outflows are also there in the subsequent period, then in that case, you will try to find out the net cash inflow, and with that we will be working. And in the last, the terminal cash inflows I'll be taking into account. Okay. When you will be taking into account the terminal cash inflows, remember, what is terminal cash inflow? First of all, try to understand before doing this slide. Understand the terminal cash inflow. I think the first two you have understood. The terminal. Terminal means the last. In the last, what happens is, in the last year, whenever the life of the machinery is being terminated, for the sake of an example, I have taken 10-year life. That means in the 10th year, you will be selling off some scrap value of the machinery will be there. Now the scrap value you realize, it can be possible. Now please remember, now whatever the scrap value you have estimated might be possible, actually you could realize more or actually you can realize less. Now if some profit or loss is there, again that tax principle will be applied. Fine. Another important point will be in the terminal year, the working capital will be released. If you remember, I had given you the point in the 0 period, you will be taking as an outflow the increase or decrease in the working capital. If it is an increase in the working capital, it will be taken as an outflow. If it is a decrease in the working capital, it will be taken as an inflow in the 0 period. Now it's the terminal, the last period. In the last period, you will be taking into account the working capital release. What is release? Release means now it's the end. It's the lifetime end of that particular machinery. That means now no production with that particular machinery. If there is no production with that machinery, what will happen? That working capital which you were taking into account, that working capital will be released. Release means that working capital you were using it for the purchase of the raw material, for the payment of the labor or wages, salaries and other expenditure. But now there will be no production. When there is no production, that means that working capital will remain an idle working capital, and therefore that will be taken as a inflow in the last year, that is called as a terminal year. Now, if that is there, just see the tax rules we will be applying over here. Whatever the tax rules are there, that I'll be applying here, that I have already told you. Now, just see the treatment of the depreciation, that I have already told you. Now, what happens is, try to understand. Generally, in the question or in your case studies, your P&L account, the balance sheet would be given. Now that means profit is being given to you, but that I have to convert it into the cash flows. What you will be doing is, whatever are the non-cash expenditure, those you will be adding it up in order to convert it into the cash flow. Okay, and whatever are the accrued or non-cash incomes, those you will be subtracting. If you do it that way, then in that case, what will happen? On the profit, suppose they have given you the profit, pay the taxation. Okay, that means that profit is being presumed that it is being given after the depreciation. Okay, when it is being given after the depreciation, on that amount, pay the taxation. After the payment of the taxation, what you will be doing? You will be getting the profit obtained after the taxation. Fine, but that is a profit. Now you have to convert that into the cash flow. That means you will be adding depreciation in that amount, that is profit after the taxation, PAT. उसमें आप क्या करेंगे? You will be adding up the depreciation. When you will be adding up the depreciation in that, whatever you will be getting, that will be the cash flows. Okay. Now that cash flow will be used for the purpose of finding out that whether this machinery should be replaced or not, whether it would be profitable to replace it or not, whether you will be having excess of cash inflows over the cash outflows or not. That is there. Now, if it is there, just try to understand. Okay, now here the depreciation is allowed on the basis of the block of asset, that is the income tax rule, that you can do it block consisting of one asset or block consisting of two assets, that you have to take into account, but this is on the basis of the income tax rules. Okay, and therefore the depreciation is there when the new asset, that is on the basis of one asset and two asset, that we are not doing it here, and therefore the depreciation, or please remember here I am taking into account the depreciation, but it will be true for all the non-cash flows item. In this way, I'll be determining the 0 period cash inflows and outflows, the other period cash inflows and outflows in order to find out the net inflows, and the terminal year cash inflows and outflows. Today, we have done only the determination of cash inflows and outflows. In the next class, I'll be doing the various methods of analyzing these cash inflows and outflows and how to take up the decision making, that whether this project should be taken up or not, whether this machinery should be replaced or not. Those things I'll be taking and continuing in the next class. Thank you.